Inflation can have a big effect on the stock market, and if you want to protect your investments, you need to know how to account for it. In this video, we will talk about how inflation affects the stock market and how you can plan your investments to take inflation into account. Before we get into how inflation affects the stock market, we should first talk about what inflation actually is. Inflation is when the price of goods and services go up over time, and this makes the currency less valuable because it can't pay or buy as much with it. Inflation is usually measured by a rate of change in the overall price level of goods and services in an economy over a certain time period, which is usually a year. There are many things that lead to inflation, such as increase in demand, the cost of making things go up, and increase in the amount of money in circulation. There are both good and bad effects of inflation on the economy. On the plus side, inflation can make people and businesses spend and invest more because they want to avoid having to pay more for goods and services. It can also help bring down the unemployment rate, since higher prices can make more people want to work. On the other hand, inflation can make it harder for people to buy things with their money, which lowers their standards of living. It can also make people spend their money faster because they want to stop its value from going down even more. Inflation can also make the economy less stable because it makes it hard for businesses to plan for the future and causes the stock market, other financial markets to go up and down. Governments and central banks use different monetary policies, like raising interest rates or cutting the amount of money in circulation to keep inflation under control. But these policies can have their own bad effects, like slowing economic growth or making more people lose their jobs. It is hard to take time for policymakers to find the right balance between controlling inflation and boosting the economy. Inflation erodes the value of money over time, and that has a significant impact on the stock market. When prices rise, companies often have to increase their prices to maintain their profit margins. This can lead to a decrease in demand for their products or services, which can ultimately hurt their stock prices. Additionally, inflation can increase the cost of borrowing money, which can lead to higher interest rates. And higher interest rates can reduce the amount of money that people have to spend and invest, which can further reduce demand for stocks. So how do you account for this in your investment strategy? One way is to invest in companies that are likely to benefit from inflation. These companies often have products or services that are in high demand during inflationary periods. For example, companies that produce essential goods like foods and healthcare are likely to maintain their value during inflationary periods. Another way to account for inflation is to invest in assets that tend to appreciate during inflationary periods, such as commodities like gold, silver, and oil. Finally, consider investing in inflation-protected securities such as Treasury, inflation-protected securities, or better known as TIPS. These securities fall under the general category of bonds, so keep in mind that the terminology that will be used to correlate to these types of securities will be related to bonds. When inflation goes up, the principal value of the TIPS go up. This means that when the bond matures, investors get more money back. When inflation goes down, on the other hand, the principal value will go down, which means that investors get less what the bond matures. So really, you are taking advantage of inflation in your own way. TIPS pays interest twice a year based on the adjusted principal value and a fixed interest rate. This interest is added to the adjusted principal value. This means that when inflation is high, you will get more money in interest, and when the inflation is low, they will get less money. They are popular with investors who want to protect their money from inflation because they offer a real return that is guaranteed. But because they protect against inflation, they have a lower yield than other types of bonds in normal circumstances. They can be bought and sold on the secondary market, and mutual funds and exchange traded funds also offer them. In summary, inflation can have a high, significant impact on the stock market, but by investing in companies that benefit from inflation, commodities that tend to appreciate during inflationary periods, and inflation-protected securities, you can help protect your portfolio from the negative effects of inflation. If you enjoyed this video, make sure to like and subscribe, and hit the notification bell if you want some updates on the channel. Thank you for watching and have a great day.